Welcome to CoreLogic's update on housing market conditions for November 2019, brought to you by onthehouse.com.au. This month, we're covering off on housing market conditions through to the end of October, as well as some focus on stronger housing credit flows and a rise in buyer activity amidst low advertised supply levels. Last month's Home Value Index results reported a 1.2% rise in national dwelling values over the month, delivering the fourth straight month of rising values. The October result was the largest month-on-month gain in the national index since May 2015. The recent gains came after a broad-based decline in housing values, with the national index declining 8.4% between October 2017 and June 2019. The positive October result takes the National Dwelling Value Index 2.9% off the June 2019 floor. However, values do remain 5.7% below their peak, highlighting that despite the recent gains, home values are at a similar level to where they were 3 years ago. The strongest growth conditions continue to be centred in Sydney and Melbourne. However, dwelling values trended higher across most of the capital cities in October as lower mortgage rates and improved credit availability spurred on buyer demand. Dwelling values went up across every capital city apart from Perth over the month, and based on the rolling 3-month change, the only capitals where values were down were Perth and Darwin. 38 of the 46 capital city sub-regions have recorded a rise in dwelling values over the most recent 3-month period, demonstrating the recovery trend is becoming more geographically diverse. The recent trend across the regional markets of Australia has seen a clear improvement in the performance of housing markets across the major centres adjacent to Sydney and Melbourne, as well as rising values in many of the coastal lifestyle markets. Conversely, drought-affected areas have seen a drop in demand for housing, with values falling sharply across many of the rural sub-regions associated with crops and grazing. Melbourne overtook Sydney in October to show the most rapid housing market recovery trend. Values were up 2.3% in October, which was the largest month-on-month change since late 2009, taking the market 6% higher since finding a floor in May. The faster pace of recovery relative to Sydney may be attributable to higher population growth, lower affordability constraints, and a more substantial rise in investment activity. Melbourne's premium value properties are leading the recovery trend, with values across the top quartile rising 7.1% over the 3 months ending October, compared with a 3.8% rise across the lower quartile. It's remarkable to think it was less than 6 months ago when dwelling values were falling across most of the regions of the country, and now we're seeing many cities recording the strongest growth conditions in several years. The combined effect of lower interest rates, improved access to credit, and a stable federal government and generally more affordable housing prices compared with a few years ago are the main factors that have supported a turnaround in housing trends. Although housing values are recovering and the trend in rising values is becoming more geographically diverse, buyer activity remains well below normal. CoreLogic estimates there were 101,000 dwelling sales over the 3 months ending October 2019. That's roughly in line with a year ago, but about 13% below the decade average. Some of the reasons for such low levels of activity include persistently weak sentiment, which is likely weighing on a willingness to make high commitment decisions, as well as low advertised stock levels and credit conditions that remain tighter relative to a few years ago, despite borrower serviceability tests recently loosening. Consumer sentiment hasn't been this low since 2015, due to households feeling increasingly pessimistic about family finances and the economic outlook. It seems that Australians are increasingly looking through the low interest rate setting to the underlying economic weakness that has pushed interest rates so low. Although new listings have increased by 65% between the seasonal winter low and the 28 days ending November 3rd, advertised listing numbers remain 14% lower than a year ago across the combined capitals, with total stock levels even lower relative to last year in Sydney and Melbourne. Advertised stock levels haven't been this low for this time of the year since 2009, and new listings being added to the marketplace haven't been this low for this time of the year ever since CoreLogic started tracking listings back in 2007. No doubt low stock levels and an increase in buyer activity is adding to some of the competitive tension in the marketplace, which is another factor pushing up prices. If stock levels start to surge higher through late spring and early summer, a rise in advertised supply could dampen some of the exuberant price growth we've seen over the second half of 2019. The value of new housing credit commitments for owner-occupiers surged 11.9% higher over the 3 months to August, and investor commitments were up 11.6%. Housing credit is clearly starting to flow again, however the rise is coming off a low base, and obtaining approval for a loan remains harder than prior to the Royal Commission, as lenders focus on borrower expenses and reducing their exposure to borrowers with high debt-to-income ratios and high loan-to-valuation ratios. If credit trends accelerate further or speculative investment becomes overrepresented in the marketplace, we could see regulators intervening in the market. If recent history is anything to go by, a new round of macroprudential policy initiatives would likely have an immediate effect on market conditions. The next few months should provide a clearer indication around how the housing market performs across higher listing numbers and higher volumes, testing the depth of the market. Of course, you can keep up to date with the timeliest trends on market conditions in your own neck of the woods at www.corelogic.com.au.